When it comes to retirement, the biggest mistake you can make is not preparing for one of the largest risks that you're going to face, and it's called sequence of return risk. So what does that mean? Sequence of return risk is essentially markets declining considerably right after you retire. And we've seen it happen quite a bit, especially recently. The dot-com bust, 2008 housing crisis, even COVID. Things like that can really derail your plans if you're not prepared for them. So I'm going to show you the best strategy I have found in order to address this. What's it called? It's called the bucket strategy. The bucket strategy, the best use of it is for people who are preparing for retirement or are already in retirement. I would say somewhere in that 5 to 10 years before retirement or in retirement phase. And it's easy to understand. Think back to 2008. Markets dropped by over 40%. So let's pretend you have $1 million portfolio. Now all of a sudden you have a $600,000 portfolio. And in order to live, you have to sell investments to live off them, right? That can be really tough when you're down 40% because you're locking in those losses. So what the bucket strategy tries to do is to mitigate those risks. And I'll explain to you how it's done. But the very first thing you're going to have to do, and nobody likes hearing this, it's not an exciting thing, but you got to calculate what your expenses are and calculate what your expenses are likely to be in retirement. Now, quickly, these are the 2 easiest ways I have found to do that. The first one is use technology. Download an app. I use Rocket Money. That's not an endorsement. It's the best one I have found personally. You download the app, it connects to your accounts, it can go back and show you by month for several years, depending on how long you've had your credit card, your bank accounts opened, what your expenses have been exactly. It's a very powerful tool. If you don't want to do that, because some people don't like connecting to these apps, just go to your local bank. What you do is you get a monthly statement or even just a total transaction report, and you take the beginning balance each month. You add in any kind of inflows, whether that be work checks, social security checks, any kind of income. You add that to that number, and then you subtract the ending balance. That'll give you a rough idea of what you spent that month. Now, how long should you do this for? I recommend at least a year, but several years is the best way to do it. The other thing I'll add to this is you have to include everything. A lot of times I'll hear people say, yeah, we had to replace our furnace last year, or our dog got sick, so we shouldn't include that. No, you should, because life happens and it's going to continue to happen. So you need to include all those expenses in there to get a good number. Once you have an expense number of how much you're spending per year, that's where the bucket strategy enters in. The bucket strategy essentially is a way of segmenting your investments out in order to make it easy to understand your strategy and to be able to stomach those downturns, which I'll talk about in just a few minutes. So let's talk about the buckets. The very first bucket I refer to as the nearly guaranteed bucket. It's not guaranteed. Nothing in life is guaranteed, but it's nearly guaranteed. This is things like high yield savings accounts, money markets accounts, your local credit union, CDs, things that are extremely low risk. How much should you put in this bucket? That's up for debate. A lot of people will typically say 1 to 2 years of expenses. This is what you're going to be living off from. This is the bucket you're going to pull from in order to support your day-to-day life. It's important to note that this bucket should not have barely any risk. Now let's talk about bucket number 2. Bucket number 2 is an income producing bucket. Things like bonds, dividend producing stocks, annuities, even things like buffered ETFs. If you don't know what those are, don't really worry about it. Just understand, we're looking for stuff that, yeah, is a little bit more risky than bucket 1, but we're still not going crazy here. Things that are going to be able to produce income for you. For bucket 2, how much of an allocation should you put into it? That depends. I say it depends because it depends on how much you have in bucket 1. Because if you only have, say, a year of expenses in bucket 1, then we're going to have more years in bucket 2. Here's a very general guideline. Typically between buckets 1 and 2, you want to have about 7 to 8 years worth of expenses. You want plenty of runway in order to be able to navigate the different twists and turns in the market and ensure that you'll be able to replenish that bucket 1. Here's an interesting data point that I like to throw out. Before 2008 happened, and the market was at a high, it took 4 years after 2008 happened to return to that same point. I think that's an interesting point because psychologically, the way I think about this is, if the worst market catastrophe in the last 100 years took approximately 4 years to return to that same point, I think that's interesting to note when you're trying to structure your investments and understand if we see a downturn, how long do we have to last? Possibly up to 4 years, maybe even exceeding it. Who knows? But I always find it's an interesting data point for people to consider. Now we move on to bucket 3. This is the growth bucket. Remember, for buckets 1 and 2, we said we're going to have roughly 7 to 8 years worth of expenses in there. That's a lot of runway. So now that we're in bucket 3, we can put together some growth-oriented assets, put together a growth strategy for that cluster of money out there to make sure that we're growing our wealth for the future, that we're able to combat things like inflation, or shoot, even maybe we want to leave a legacy for our kids. Whatever the reason is, it's very likely you're going to want to have the rest of your money in growth assets. Growth assets, it's a large spectrum, but you're probably going to have a heavy dose of stocks in this bucket, maybe even some growth-oriented stocks, meaning like tech sector, small and mid-cap companies, things like that. It's up to you to understand what the strategy is. I'm just showing you how the bucket strategy works as far as structuring your investments. So the overall strategy is, each bucket has a different time horizon. Like I said, first bucket, maybe 1 to even up to 4 years, and then 2 to 7 years in bucket 2, and then the third bucket, 8+ years. And I think this helps people when you're trying to explain your strategy to them and how we're going to be able to make sure that their money outlasts them. Here's the other biggest thing I found though. When we do hit those market downturns, it's easy to be able to point to these buckets and say, we're prepared for this. We are prepared to live through these exact types of scenarios. I see it all the time. I've seen it even this year when the market was down and people are calling and said, hey, I was watching the news, which by the way, the news isn't there to give you information that's going to be helpful. It's there to draw your eyeballs, just as a side note. But people watch the news and they get fearful because that's what the news does to us. And they ask me, should I be moving more money into CDs? Should we get more conservative? You point to this strategy. Say, hey, we're prepared for this. Look how much money we've got stashed away. And as markets ebb and flow, we're going to be replenishing. We're going to be okay. I'm telling you, the relief that comes across people's faces when they realize it, that is the whole reason to me why this strategy is so powerful. When it comes down to it, how much is a good night's rest for you? How much is it worth to you? How much is peace of mind worth to you in retirement? To most people, I'd say it's worth a whole lot. So here's some common objections I hear from the strategy. I will be the first to say, no strategy is perfect. The bucket strategy is not perfect. It's just the best one I have found. So people will ask about holding so much cash, and saying bucket 1 and saying, oh, isn't that a drag on your returns? Honestly, yeah, it is. If you take a look at historic numbers, you're probably better off putting all your money in the stock market and just understanding that you're going to have to stomach those waves. But here's the deal. I always say, we're not robots. You're not a robot. You have emotions. I have emotions. Do I like seeing market downturns? No, I don't. And so what this strategy allows you to do, and having so much cash on hand, is it allows you to stay put. It allows you to not make an emotional decision when we're seeing those downturns. And that will trump any kind of benefit that you might possibly have in a stock market more times than not, just because you're able to handle it from an emotional standpoint. The cash drag to me is not as big of an issue as it is the sequence of return risk possibility that most retirees see. And then other people will say, this is no different than just a balanced portfolio. And once again, I would say to them, you're mostly right. When you put the 3 buckets together and you take a look at the entire investments, it's essentially a balanced portfolio most of the time. I get that. But once again, being able to understand it and explain it to people is far more powerful than just saying, hey, throw all your money in a balanced portfolio. Because when I get those phone calls, when people are kind of starting to get a little antsy, a little upset about where things are, it's hard to say, no, you're fine because you're in a balanced portfolio. It's much easier to explain when you say, remember bucket 1, we've got plenty of room for expenses. And even in bucket 2, remember we have investments that are going to be able to replenish bucket 1, even if we see a market downturn. That gives people peace of mind. That to me is much more powerful than throwing money into a balanced portfolio. So when it comes down to it, here's why I think this strategy is so powerful. First, financially, it's extremely sound. When you back test it, you run these numbers. This type of a strategy works extremely well for people and helps ensure that they're going to outlive their money. The second piece I think is so powerful is the emotional protection. It protects us from ourselves. The longer I do this, the more I am convinced that the hardest part of investing, the hardest part of financial planning, is the emotional impact. It's the scars we have from the past. It's the fact we lived through 2008 and we're always worried that's going to happen again. That's what this strategy does. It's going to give you peace of mind. It's going to help you understand how your investments are structured and how you're going to be able to weather whatever it is that the financial world throws at you. And so with that, now you have, in my mind, one of the most powerful tools that there is, financial planning in retirement. So be sure to use it in your own strategy. If you're still a little leery about this and you'd like to talk things over, look at the link in the description, set up some time with us. We'd be happy to talk it through with you. Thanks for watching.